So how do you time the stock market? I know you're going to say, you can't time the stock market. You can't know where it's going. Well, because of technology and because of derivatives market, you can get a better idea and get in the ballpark with the big guys. And that's what we talk about at Best of US Investors on the Morning Edge. I review where the indexes are going in highly liquid stocks. So here's how you do it. You buy a stock, you sell a stock. There is somebody on the other side of each one of those trades, and he or she is referred to as a market maker. And they are exactly what their name is. They make a market. So you buy a stock, and let's say you buy 100 shares of Apple. That market maker then sells you those shares. But then they become short those shares. So they are basically borrowing those shares, or if they have an inventory of them, they're borrowing those shares. So they're short that 100 shares of Apple that you just bought from them. So now they're vulnerable. So what do? Well, if Apple's price goes up, they lose money. So what do you do if you're going to lose money and you owe people money? You hedge your position. And that's where derivatives, or in particular, in this case, options come into play. So let's say you buy Apple at hypothetically $200 a share. They are now short 100 shares at $200 a share. So their concern is Apple's going to go up higher. And so what they'll do is they'll go out to the options market and they will buy options on Apple. And based on their calculations, let's say $210 a share on Apple is where it's going to head to and where it's going to peter out. So they'll buy options on that, equating to the equivalent market value of 100 shares of Apple that you bought at $200. So they'll buy call options. Why are they using call options? Because they're cheap. They're inexpensive. So if a stock goes up, their call options will increase in value. So that potential loss from where they sold it to you, where they're short at 200, between that and 210, they make up the difference and they basically zero out. Okay, so that gives you an idea where the roof is. Now let's flip it over and say NVIDIA. Go back a week, maybe 2 weeks. NVIDIA hit $210 a share. And you want to short NVIDIA because you believe NVIDIA is going to go lower. And let's say you think it's going to go to $200. The market maker, sell shorts that lets you borrow that stock, basically. So they're now, they now need to hedge their position because now, once again, they've lent you that stock. You've shorted that stock. They have had to buy that stock, so they're long it. And if you're right, and the price of NVIDIA goes from 210 to 200, they're going to lose money. So what do? They buy puts. But they're really smart, and they're always smarter than you because they see the market. They see what's happening, and they'll put in a couple different levels. So they'll put in at 200. They will buy puts at 200. So if it goes to 200, they have made the difference from where they shorted it, where you shorted it at 210, and they lent you the money. So now their inventory, they own NVIDIA at 210. It drops to 200, their puts hedge them out. If it goes to where it got to Friday, 180, they then have another level, and that would be called the second put wall. First put wall is at 200. Second level would be, say, at 180. And then I think the third level was 178. So the volume is less as you go further through the initial target price of 200. Okay, so they're doing this. This is costing them money to hedge these positions. So what they can do is zero out the cost of it by, if you short it at 210 and it goes to 200, they bought puts So they want to zero out that cost. They will then sell calls at 210 to pay for the cost of those puts. And basically, essentially making it, it's called a zero cost collar. And they zero out the cost of those hedges. But think of this from the dynamics of how many shares of NVIDIA trade on a daily basis. Millions. So they're dynamically changing these hedging positions throughout the day, throughout the week, and throughout the month. But what this can give you is insight to where support and resistance is. Remember, the market maker is making a market for you, the retail investor, the institutional investor, the person whose institution's coming in, instead of buying 100 shares, they're buying 10,000 shares. So the market maker is always at risk. Now, how does a market maker make money? They don't care about the directional movement of a stock. They care about what they have to go out and buy it for and what they have to go out and sell it to you for. And that is called the spread. And that is your bid ask. When you buy a stock, you get the asking price. And they have gone out and bought the stock at a lower price, so more like the bid, and they turn around and sell it to you. And they make the difference between what they bought it for and what they sold it to you for. When you sell a stock, they sell it to you, they buy it back from you at the bid in hopes that they have bought it at a, they bought it at a higher price. Anyway, it gets super complicated, but you can essentially use the options market and market maker put a delta hedging, they refer to it as delta hedging, as a way to determine where the stock's going. NVIDIA hit at $210. It stopped right on the dot. And then it started moving higher. It got as low as 180 last week, Friday. And then it hit that level. So those put contracts paid out. And all of a sudden it reversed into Friday's close. And it closed higher than it opened up, which should tell you something. What is it going to do next week? Now, of course, there's a million other variables involved in this that affect all of this. But one of those things is volatility hedging, or vol controlled funds. And what we saw at the end of Friday was volatility being suppressed and volatility control funds coming back in and putting risk back on. And now we're seeing these transactions between market makers and their hedging strategies. And chances are you will see NVIDIA move higher next week because of these variables we don't ever consider. Remember, they're not based on fundamentals. They're not based on global macroeconomic conditions. They're not based on these things. They are based on hedging strategies that market makers use. Use this information. This is information that I cover every Monday through Friday on the Morning Edge. This is for, try us out, 14-day free trial. Go to the link in the profile and sign up. Because at the end of the day, you don't have to be a day trader. And we're not about day trading. We're about long-term fundamental analysis using technicals. And we cover that in our swing trading portion of the Morning Edge, and how to use technicals to make money on both the short term, but also the long term. And then risk management. Mark, what I just shared with you is risk management. You need to become a better investor because markets will get more and more volatile as time goes on. And if you can manage your risk, the upside returns will always take care of themselves. Hit the subscribe button, the like button, leave a comment, and give us a try, a 14-day free trial. Click the link in the profile. Have a great day. Have a great weekend. Live loud. See ya.